California's housing market is doing the unthinkable, it's cracking. While headlines tout million-dollar tear downs, certain cities aren't just cooling, they're in freefall, with staggering drops of 1% to nearly 7% in a single year. This isn't a gentle correction, but a harsh reality check. If you've ever considered buying property here, what's next could save you tens of thousands or help you dodge a financial disaster. For current owners, buckle up. We're exploring the top 10 California cities where home prices are expected to decline in 2026, starting with San Jose. You rolled into Silicon Valley thinking you'd made it. Tech jobs, innovation, and money everywhere. But San Jose's median home price, once sky high, dropped 5.5% year over year by December 2025. This translates to six-figure losses for recent buyers in a market still averaging over $1 million. So, what went wrong in America's tech capital? The party ended. Tech layoffs between 2023 and 2025, from giants like Meta and Google, trimmed aggressively. Those workers, who owned or rented million-dollar properties, are now gone. Inventory is piling up, shifting power to buyers. Even with a 5.5% drop, affordability in San Jose is still a fantasy. A median income household would need 63% of its income just for the mortgage, assuming a 20% down payment. Would you bet your life savings on a market where people who can afford homes are getting laid off in waves? Next, Napa. You show up thinking you found paradise, but the only thing aging well here is the vintage, not your investment. In the past year, Napa's average home price decreased by 4.2% to $859,745. And it's not done falling. Here's where it gets ugly: a full 68% of homes are selling below asking price. More than 2/3 of sellers are taking less than hoped. Homes sit for 47 days, compared to the national average of 29. Buyers aren't rushing in, they're walking away. What killed the Napa dream? Tourism took a hit, remote workers returned to offices, and luxury buyers questioned spending nearly $1 billion an hour from San Francisco. Gas costs $5, traffic is miserable. A local agent bluntly stated, "Properties that were deals 2 years ago are now overpriced." Now San Diego. You expect endless beach days and perfect weather, but what you find is one of the biggest housing crashes in the country, still picking up speed. San Diego just posted a sharp 6.7% price drop year over year, the second largest decline in the US. What's driving this coastal collapse? Experts call it a perfect storm: high insurance, stubborn inflation, and eye-watering condo fees. Layer on economic uncertainty, and buyers choose to rent. Senior economist Joel Berner noted, people are worried about their income and not feeling it's a great time to move. Here's the twist: even with prices falling, homes in San Diego are still selling in about 31 days. The market is moving, just downward. Would you buy $1 million property in a city where prices have dropped 6 months straight with no bottom in sight? Moving to Sacramento. You thought you cracked the California code, cheaper than the Bay Area. But Sacramento's median home price dropped 3.3% over the past year to $469,542, with Zillow forecasting another 1% slide. Affordable California is becoming a myth. What changed in Sacramento? Population growth slowed to almost nothing. The escape from San Francisco wave dried up, and commuting became torture. Inventory is exploding, up 47% year over year. More homes, fewer buyers and sellers realizing 2021 asking prices aren't coming back. The shift from a seller's market to a balanced one in Sacramento is just beginning. Would you buy into a city where the main selling point was affordability, and even that's starting to crack? This trend is picking up steam. Finally, San Francisco. You expect innovation and success stories. Instead, you find a housing market losing value for 3 straight years. Prices are down 2.5% according to forecasts, and nearly 15% off their 2022 peak of $1.459 million. Now let's move to Los Angeles, where the median home costs nearly $943,000, and it's sliding. A 1.2% drop last year might sound small, but remember, in a market this expensive, even a tiny percentage means serious money lost for recent buyers. High insurance costs, relentless inflation, and soaring condo fees are crippling LA's market. Many buyers are choosing to rent, while current owners, locked into low pandemic rates, refuse to move. This creates a supply-demand paradox. Next, Riverside, once seen as the affordable escape from coastal California. Its median home price dropped 2.5% to $575,000 last year. This proves that even the budget-friendly alternatives aren't safe from the broader market correction. The job market here is crumbling, with warehouse and logistics work hit hard by automation. Inventory is piling up, with homes sitting for 60 days. What's more concerning, 26% of buyers in Stockton are actively searching to move out. Who's buying? Moving to Stockton, its median home price crashed 4.1%, with some sources reporting drops up to 5.5%. This city has struggled with economic growth for decades, and now, buyers are bailing faster than ever. This isn't just a dip, it's an acceleration. Homes in Stockton are now taking 48 days to sell, up from 38 days last year. A staggering 26% of buyers are already planning their escape before they even close on a property. Zillow forecasts another 1.2% drop. When buyers flee, prices follow. Now, Modesto, identified as California's most overpriced housing market, sitting roughly 32% above its expected value. This wasn't a sustainable growth. It was a market running on pure hype and hope, rather than economic reality. During the pandemic, buyers flooded Modesto, thinking they'd found a bargain. Now, many are underwater. Living costs here are still 13% above the national average, without the job market or amenities to justify it. This is a tough sell. Finally, Oxnard. Average home price over $867,000, double the national average, and identified as 16% overpriced. Coastal location used to be a selling point, now it's a liability, with major insurers pulling out and premiums soaring past $6,000 a year. Beyond insurance, Oxnard faces an infrastructure mess with leaky pipes and fines for watering plants. Property taxes haven't budged, even as values drop. Tourism is slowing, remote workers are leaving, the beach view simply isn't worth the escalating costs. So, what's truly driving this collapse across California? It's a perfect storm: mortgage rates stuck above 6%, insurance costs rising out of control, relentless inflation eating paychecks, and fees piling up everywhere from HOAs to property taxes. Then there's the brutal mortgage lock in effect. Homeowners who bought during the pandemic locked in rates below 4%. Moving now means trading that for 6% or higher, an extra $400 to $900 per month. Most would rather stay put. California has a second lock-in, Proposition 13. Property taxes are based on your purchase price, not current value. Longtime owners pay a fraction of what new buyers would. Moving means higher mortgage rates and resetting property taxes. A financial disaster. So, what does this mean for these 10 cities? Fewer homes are hitting the market, but the ones that do must drop prices to attract buyers. Sellers are now competing, not buyers. This fundamental market shift is accelerating, putting downward pressure on values. Economic uncertainty isn't helping. People are genuinely worried about jobs and income, making them hesitant to commit to the biggest financial decision of their lives. When doubt creeps in, buyers vanish, and when buyers disappear, prices inevitably fall. Beneath the surface, a perfect storm is brewing. Mortgage rates stubbornly high above 6%, insurance costs spiraling out of control, and inflation relentlessly eroding your purchasing power. This isn't just a market blip, it's a profound shift. Mortgage rates, stuck persistently above 6%, represent a massive psychological barrier. Buyers who once dreamed of a 3% fixed rate now face dramatically higher monthly payments, making homeownership feel out of reach, even with falling prices. Then there's the soaring cost of insurance. Coastal California, once a dream, is now a liability as major insurers pull out, leaving homeowners with annual premiums climbing past $6,000. It's turning paradise into a financial headache. Inflation continues to eat away at paychecks, while condo fees, HOA dues, and property taxes keep climbing. These hidden costs, which rarely drop even when home values do, add significant pressure, making the overall cost of ownership unbearable for many. This leads us to the brutal lock in effect. Homeowners who bought during the pandemic secured mortgage rates below 4%. Moving now means trading that golden handcuff for a new mortgage at 6% or higher, a financial decision few are willing to make. Quantifying this, moving from a 3.5% rate to a 6.5% rate on a $500,000 mortgage means an extra $900 per month. That's over $10,000 annually. Most would rather stay put than voluntarily spike their housing costs by nearly $1,000 monthly. This isn't just about math, it's about behavioral economics. The pain of losing a low rate far outweighs the pleasure of gaining a new home. Most homeowners are psychologically anchored to their current payments, creating a massive inertia in the market. California adds a second, unique lock-in Proposition 13. Your property taxes are based on your original purchase price. For long-time owners, moving means not only higher mortgage rates but also resetting property taxes to current market values. It's a double whammy. Imagine you bought in LA 20 years ago, paying a fraction of today's property taxes. Moving means not only a 6% plus mortgage, but also property taxes potentially doubling or tripling. This effectively traps long-time owners, creating a financial disaster if they try to relocate. What's the consequence? Fewer homes are hitting the market. Owners are locked into their low rates and taxes, unwilling to sell unless absolutely necessary. This artificially constrains supply, but it doesn't solve the underlying demand problem. Despite low inventory, the homes that come onto the market must drop prices to attract buyers. The balance of power has shifted. Sellers are now competing for a smaller, more hesitant pool of buyers, not the other way around. Economic uncertainty isn't helping. People are genuinely worried about job security, income stability, and whether now is truly the right time for the biggest financial commitment of their lives. This hesitation translates directly to lower demand. This is the critical psychological tipping point. When doubt creeps into the minds of potential buyers, they don't just pause, they vanish. Fear of buying at the peak or catching a falling knife becomes a powerful deterrent. The equation is simple: when buyers disappear, demand plummets. When demand plummets, prices have nowhere to go but down. This isn't just a correction, it's a recalibration of market expectations, driven by shifting economic and psychological landscapes. So, what's your take? Did your city make the list, or are you seeing these trends in your neighborhood? Share your real estate horror stories below. And remember to hit like and subscribe to Houseline USA so you don't miss the next market warning. Beneath the surface, a perfect storm brews. Mortgage rates stuck above 6%, insurance costs spiraling, inflation eating paychecks, and those relentless HOA and property taxes. It's an economic pressure cooker for homeowners and buyers alike. Then there's the lock-in effect. Many homeowners secured rates below 4% during the pandemic. Moving now means jumping to 6% or higher, an extra $400 to $900 monthly. Most prefer staying put over voluntarily spiking their housing costs. California adds another layer with Proposition 13, basing property taxes on purchase price, not current value. A long-time owner might pay half what a new buyer does for the same house. Moving means resetting taxes and higher mortgage rates, a recipe for financial disaster. What does this mean for these cities? Fewer homes hit the market, but the ones that do must drop prices to attract buyers. The dynamic has flipped. Sellers are now competing for buyers, a stark contrast to the bidding wars of recent years. This shift is accelerating. Economic uncertainty isn't helping. People are genuinely worried about job security, income stability, and whether now is the right time for the biggest financial commitment of their lives. This fear paralyzes decision-making, especially for high-value assets. When doubt creeps in, buyers simply vanish. They pull back, wait for clarity, or look for safer havens. When buyers disappear, demand plummets and prices inevitably follow suit. It's a simple, brutal market mechanism at play. So, we've explored how specific California cities are facing these pressures. But this isn't just about local markets or individual decisions. What's truly driving this collapse are deeper macroeconomic forces. Let's zoom out to see the bigger picture. These aren't isolated events. They're symptoms of larger macroeconomic forces at play. Think about the Federal Reserve's aggressive interest rate hikes, global supply chain disruptions, and shifting demographic patterns. These ripples impact every corner of the housing market. High interest rates, driven by the Fed's fight against inflation, directly translate to higher monthly mortgage payments. A $500,000 loan at 3% is vastly different from one at 7%. This drastically reduces buying power and affordability, especially in expensive markets. Persistent inflation erodes purchasing power, making it harder for households to save for down payments or absorb higher housing costs. It also drives up construction costs, slowing new supply. This double whammy squeezes both buyers and the overall market. California's unique insurance crisis is another major headache. Major insurers pulling out, leaving homeowners with expensive alternatives where premiums climb past $6,000 a year for some properties. Coastal living, once a selling point, is now a financial liability. Beyond the financial squeeze, a demographic shift is underway. Many are leaving California for states with lower costs of living and better job prospects. This California exodus reduces the overall buyer pool, dampening demand and accelerating price corrections. This market shift impacts everyone differently. First-time buyers face daunting affordability, while seasoned investors might see opportunities amidst the volatility. Understanding your position and risk tolerance is paramount in these uncertain times. Is this merely a market correction, or a deeper structural shift? The confluence of high rates, rising costs, and demographic changes suggests more than just a temporary blip. We might be witnessing a fundamental re-evaluation of California's housing value proposition. So, what's your next move? Monitor local inventory levels, watch interest rate trends from the Fed, and understand your personal financial situation. Don't make emotional decisions. Hit like and subscribe to Houseline USA for more crucial market warnings. Oxnard's average home price, over $867,000, was already 16% overpriced. Now, coastal insurance costs are soaring past $6,000 annually for some, turning a dream into a financial burden. Would you pay double the national average for a home whose value drops while costs climb? Modesto, once California's most overpriced market by 32%, now faces a harsh reality. Pandemic buyers are underwater as prices correct. Living costs remain 13% above the national average, without the job market to support it. Is this a sustainable investment for your future? Stockton's median home price crashed 4.1%, with some sources showing drops up to 5.5%. Homes take 48 days to sell, and a staggering 26% of buyers are actively looking to leave. Is this a market you'd confidently invest in, knowing a quarter of its potential buyers are planning their exit? Riverside, once a budget-friendly alternative, saw its median home price drop 2.5%. Job losses in logistics due to automation are hitting hard, and 26% of buyers are searching to move out. The escape hatch from coastal prices is now an exit ramp. Are you prepared for this demographic shift? Los Angeles median price dropped 1.2%, but this hides deeper neighborhood declines. High insurance, inflation, and climbing condo fees are pushing buyers to rent. Existing owners locked into low rates refuse to sell, stagnating inventory. Would you enter a market already sliding downhill? San Francisco's market is down 15% from its 2022 peak. Tech layoffs have emptied condos, with HOA fees exceeding $1,200 monthly. Affordability remains a fantasy even with falling prices. Is the tech capital losing its luster, or is this a long overdue correction? Sacramento's median home price dropped 3.3%, with Zillow forecasting another 1% slide. Population growth stalled as remote work ended, and inventory surged 47% year-over-year. Buyers now have leverage against unrealistic sellers. Is affordable California still a viable investment strategy? San Diego just posted a sharp 6.7% price drop, the nation's second largest. A perfect storm of high insurance, relentless inflation, and rising condo fees forces buyers to rent. The market moves, but only downwards. Would you buy $1 million property with no bottom in sight? Napa's average home price decreased 4.2%. A shocking 68% of homes sell below asking, sitting on the market for 47 days. With tourism down and remote work fading, luxury buyers are re-evaluating this paradise. Is the allure of wine country fading, or are buyers simply becoming more rational? San Jose, once a tech boom town, saw a 5.5% drop in home values, translating to six-figure losses for recent buyers. Massive tech layoffs created a buyer's market. With 63% of income for a mortgage, affordability is a distant dream. Is Silicon Valley's real estate immune to market forces? What drives these widespread declines? A perfect storm of factors. Mortgage rates stubbornly above 6%, skyrocketing insurance costs, relentless inflation eroding paychecks, and ever-climbing HOA and property taxes. These combined pressures make homeownership increasingly unsustainable. A brutal lock-in effect traps homeowners. Those who bought during the pandemic secured rates below 4%. Moving now means trading that for 6% or higher, an extra $400 to $900 monthly. Most prefer to stay put, creating a scarcity of listings. How does this impact your buying power? California adds a second layer of lock-in Proposition 13. Property taxes are based on purchase price, not current value. Longtime owners pay a fraction of new buyers, making any move a double financial hit. This unique policy distorts the market, creating further disincentives to sell. This creates a unique market shift. Fewer homes hit the market, but those that do must drop prices significantly. Sellers now compete for scarce buyers. Economic uncertainty fuels doubt, making buyers vanish and prices fall. The power dynamic has irrevocably shifted from sellers to buyers. These aren't random drops, they're clear patterns driven by fundamental shifts. Understanding these forces can help you navigate this volatile landscape, whether you're buying, selling, or investing. Are you equipped to spot the next warning sign before your equity disappears? We've uncovered the perfect storm brewing in California's housing market, from soaring insurance to the brutal lock-in effect. But what does this mean for your financial future, whether you're buying, selling, or just watching from the sidelines? For first-time buyers, this market correction isn't just about falling prices. It's about a rare window. Lower valuations could mean a more attainable entry point, but only if you navigate the high interest rates and tight credit wisely. Don't jump in blindly. Focus on pre-approval, understanding your true affordability with current rates, and negotiating hard. Data shows homes sitting longer, giving buyers leverage they haven't seen in years. That's power. If you're an existing homeowner, especially one who bought at the peak, you're facing a different reality. Decreased equity, the lock-in effect, and rising costs can make moving feel impossible, trapping you in a depreciating asset. For sellers, waiting for peak prices to return is a gamble. Consider strategic pricing, minor upgrades for appeal, and understanding your competition. A quick, decisive sale at a realistic price can often save more than holding out. Investors, this market presents a paradox. While some see risk, others see opportunity. Distressed properties, foreclosures, or strategic long-term buys in fundamentally strong areas could yield future returns, but due diligence is paramount. The Federal Reserve's stance on interest rates remains a critical variable. A pivot could inject liquidity, but a sustained higher for longer approach will continue to depress buying power, further extending this market correction. A collapsing housing market isn't isolated. It ripples through the economy, impacting local businesses, construction, and even consumer confidence. This slowdown extends beyond real estate, affecting jobs and spending across sectors. In volatile markets, our psychology becomes our biggest enemy. Avoid anchoring to peak prices, succumbing to loss aversion, or making emotional decisions. Data, not fear or hope, should guide your financial choices. This market underscores the absolute necessity of robust financial planning. A diversified portfolio, emergency fund, and clear long-term goals act as your shield against unexpected market shifts, whether up or down. While real estate is a powerful asset, overconcentration in one market, especially a declining one, can be perilous. Consider diversifying into equities, bonds, or other alternative assets to spread risk and seek growth elsewhere. Beyond traditional markets, consider growth sectors like AI, renewable energy, or emerging markets. For those seeking income, high-yield savings or certain dividend stocks can offer stability when property values falter. Is this a cyclical correction or a fundamental shift for California? History suggests cycles, but unique factors like climate change risks and affordability crises could mean a slower, more prolonged recovery than past downturns. So, what's your immediate next step? Assess your personal financial situation, reevaluate your long-term goals, and, most importantly, educate yourself continuously. Knowledge is your greatest asset in any market. Don't just watch the market, understand it. If you found this analysis valuable, hit the like button, share this video, and subscribe to Houseline USA for more crucial insights that help you build wealth and avoid financial pitfalls. Up to this point, we've explored the stark reality of California's housing market. But these aren't random price drops. There's a clear, escalating pattern driven by several critical factors beneath the surface. Understanding these will equip you to navigate this turbulent market. First, the perfect storm. Mortgage rates are stubbornly stuck above 6%, a stark contrast to the sub 4% rates just a few years ago. This doesn't just increase your monthly payment, it prices out a huge segment of potential buyers, fundamentally altering demand. Then there are insurance costs, especially for coastal California properties. Major insurers are pulling out, leaving homeowners with expensive alternatives where premiums can climb past $6,000 a year. A coastal view becomes a financial liability, not an asset. Add relentless inflation eating paychecks, climbing HOA fees north of $1,200 a month in some areas, and property taxes that never seem to drop. The total cost of homeownership has simply become unmanageable for many, even with falling prices. Then there's the brutal lock-in effect. Homeowners who bought during the pandemic locked in mortgage rates below 4%. Moving now means trading that for a 6% or higher mortgage, an extra $400 to $900 per month. Most would rather stay put. California adds another layer with Proposition 13, basing property taxes on purchase price, not current value. Longtime owners pay a fraction of what new buyers would. Moving means higher mortgage rates and resetting property taxes a double financial disaster. This lock-in effect means fewer homes hit the market. But the ones that do must drop prices significantly to attract buyers. The dynamic has shifted. Sellers are now competing for buyers, rather than the other way around, and this shift is accelerating. Economic uncertainty isn't helping. People are genuinely worried about jobs, income, and whether now is the right time for the biggest financial commitment of their lives. When doubt creeps in, buyers vanish. And when buyers disappear, prices inevitably fall. Many held on to the illusion that California real estate only goes up. This behavioral bias, fueled by years of appreciation and FOMO, led many to buy at the peak. Now, it's a harsh reality check for those who bet their life savings on an endless ascent. San Jose teaches us the danger of over-reliance on a single industry. Tech layoffs between 2023 and 2025 like Meta and Google removed the high-income buyers. Even with a 5.5% drop, affordability is still a fantasy, requiring 63% of median income for a mortgage. Napa highlights the vulnerability of luxury and tourism-dependent markets. A 4.2% price decrease and 68% of homes selling below asking price reveal a painful disconnect. When tourism slows and remote work ends, perceived paradise values quickly deflate. San Diego illustrates how the perfect storm creates a coastal collapse. A 6.7% price drop, the second largest in the nation, driven by high insurance, inflation, and condo fees. Even with prices falling, buyers choose to rent, fearing the mounting total costs. Sacramento reveals the limits of affordable alternatives. A 3.3% price drop, with another 1% forecasted, as population growth slowed. The escape from San Francisco wave dried up when remote work ended, and painful Bay Area commutes became reality again. San Francisco, once untouchable, is down 15% from its 2022 peak. Downtown condos, some down over 55%, rack up HOA fees north of $1,200/month. Tech worker exodus and extreme non-affordability, even at current prices, cripple this iconic market. So, what's your take? Did your city make the list? Are you seeing these troubling trends in your neighborhood, or perhaps you have a real estate horror story to share? Drop it in the comments below. We want to hear your perspective. We've seen the numbers in California cities, but these aren't random drops. A clear, accelerating pattern is emerging beneath the surface, threatening widespread financial implications for homeowners and prospective buyers alike. It's about to get worse. The perfect storm everyone mentions includes mortgage rates above 6%, skyrocketing insurance costs, and relentless inflation eroding paychecks. Layer on ever-increasing HOA and property taxes, and the total cost of ownership becomes unsustainable for many, adding up fast. Then there's the brutal lock-in effect. Homeowners who bought during the pandemic locked in rates below 4%. Moving now means trading that for 6% or higher, adding an extra $400 to $900 per month. Who would voluntarily spike their housing costs by nearly $1,000? California adds a second, even worse lock-in Proposition 13. Property taxes are based on your purchase price, not current value. A longtime owner in LA might pay half what you'd pay for the same house today, making moving a financial disaster. This means moving equals both higher mortgage rates and resetting property taxes to current values. For many, it's a double whammy, making upgrading or relocating an impossible financial hurdle. Their equity is trapped, contributing to market stagnation. So, what does this mean for California's cities? Fewer homes are hitting the market, but the ones that do must drop prices significantly to attract buyers. The shift from a seller's market to a buyer's market is accelerating, and it's a brutal transition. Instead of buyers competing for scarce inventory, now sellers are the ones vying for attention. This fundamental power shift means longer listing times, more price reductions, and a new reality where buyers have leverage they haven't seen in years. Economic uncertainty isn't helping. People are genuinely worried about jobs, income stability, and whether now is the right time for the biggest financial commitment of their lives. This doubt is a powerful force, driving potential buyers away from the market. When doubt creeps in, buyers vanish. When buyers disappear from the market, prices inevitably fall. This isn't just a correction, it's a re-evaluation of value in a changed economic landscape, impacting everything from Silicon Valley to wine country. So, what's your take? Did your city make our list of California's declining housing markets? Are you seeing these troubling trends, rising inventory, price cuts, or longer listing times in your own neighborhood? Share your observations below. Do you have a real estate horror story from the current market, perhaps buying at the peak or struggling to sell? Your experiences offer invaluable insights into the psychological and financial toll of a shifting market. We want to hear them. Understanding these underlying market dynamics can save you tens of thousands of dollars. Whether you're a buyer hoping for a better entry point or an owner navigating a softening market, this knowledge helps you dodge a financial disaster. For current owners, this means critically evaluating your equity and understanding the true costs of holding versus selling. For prospective buyers, it means patience, thorough due diligence, and recognizing that today's market offers new opportunities for negotiation. Don't miss the next market warning before your equity disappears, or you overpay for a rapidly depreciating asset. We're here to provide the insights you need to make informed decisions and protect your financial future. Hit like and subscribe to Houseline USA. Your support helps us deliver crucial market analysis and warnings that can impact your wealth. Stay ahead of the curve and make sure your investments are protected. What's truly driving this California housing collapse? It's a perfect storm: mortgage rates above 6%, skyrocketing insurance, relentless inflation, and piling HOA fees. These costs combine to create a significant financial burden. Then, there's the brutal lock-in effect. Homeowners who secured rates below 4% during the pandemic now face 6% or higher mortgages. This means an extra $400 to $900 monthly, making voluntary moves financially punishing. California's Proposition 13 adds another layer of lock-in, basing property taxes on purchase price, not current value. Longtime owners pay significantly less. Moving means higher mortgages and resetting property taxes, a true financial disaster. This means fewer homes are hitting the market. The few that do must drop prices significantly to attract buyers. The shift from a seller's market to one where sellers are competing for buyers is accelerating. Economic uncertainty isn't helping. People are genuinely worried about jobs, income stability, and whether now is truly the right time for the biggest financial commitment of their lives. Doubt is a powerful deterrent. When doubt creeps in, buyers vanish. And when buyers disappear, prices fall. This isn't random. It's a predictable market reaction to a confluence of financial and psychological pressures. The trend is clear. So, what's your take? Did your city make the list? Are you seeing these trends in your neighborhood? Share your real estate horror story or insights in the comments below. We want to hear from you. And remember to subscribe to Houseline USA. Don't miss the next crucial market warning before it's too late and your hard-earned equity disappears. Stay informed, stay ahead.